Thought I'd do a quick video on the economy of Europe as a whole and how their GDP is doing. The summary is it's not great. Compared to Canada and the US, Europe as an entire continent seems to be dragging behind. It might seem not the best to loop in all of the European countries into one bucket. So let's be a little bit more specific. For the Euro era, specifically all the countries using the Euro as a form of payment or a form of exchange, the GDP growth in the second quarter of 2025 was just 0.1%. The European Commission, real GDP growth in the second quarter of 2025 was just 0.1% quarter over quarter. For the wider European Union, growth was slightly higher, 0.2% in Q2. On a year-on-year basis, the growth from the euro was about 1.4%, and the EU around 1.5%. Europe's growth is very modest, signaling a sluggish economic backdrop. Meanwhile, the United States in Q2, real GDP rose by 3% on an annualized rate. The forecast in the US next year is that the growth should be about 1.4%. This was stated in an article that Deloitte published. All to say, the US is outperforming Europe by a decent margin. Canada is not doing so bad itself. Not as good as the US is doing, but not bad altogether. The Q1 2025 GDP grew by 0.5% compared with previous quarter. The annual growth forecast for Canada in 2025. Canada is somewhere between Europe and the US, but not as far behind as Europe. What does this mean overall for Europe? If you're investing in funds, stocks, the US may offer stronger growth opportunities in the near term, but for Europe, slower growth means more caution, possibly lower corporate earnings or slower wage growth, slower unemployment. Canada may pick up overall trade and domestic demand. Canada may pick up overall if trade and domestic demand improves, but it's not doing as great as the US is doing. In fact, based on all the tariff talks, there might be even more decline coming for Canada. But we all know that due to Trump's tariffs and a lot of the conflicts across many parts of Europe, it can affect the overall growth and the overall GDP and production which we're seeing. And some of these key drops in overall GDP can be attributed to high interest rates and persistent inflation. The European Central Bank has raised interest rates aggressively to fight inflation over the past a few years. The high borrowing costs have slowed businesses, investment, mortgages, and lending, all of that stuff. And structural weaknesses in key economies like, Germany being traditionally a powerhouse for the automotive sector hasn't seen as great as an impact across the world, especially in the US with, again, the tariffs, declining manufacturing competitiveness, reduced demand even from China has also seen some significant impacts in the whole EU economy. And the energy crisis and transition costs is a whole other topic. Europe is transitioning away from fossil fuels a bit faster than other regions across the world, leading to a high short-term cost without immediate productive gain. So we've seen a lot of heavy investments in that sector and hoping to see a huge payout later on. There's a lot of dependency on imported energy, especially post-war. It keeps energy prices high, and industries like chemicals, steel, and automotive manufacturing, again, have been hit hard, again, with the tariffs in the US. It's important to also remember that Europe has an aging population and a high labor shortage. The Eurozone countries have low birth rates and aging population. Workforce participation is declining. Many people want to just sit home, do YouTube, or leave Europe altogether. There's a few other issues, geopolitical risks, fiscal constraints, but all to say the GDP isn't looking great, and it might not rebound for a significant amount of time, at least for the near future. Anyhow, that's it for this video. Cheers. See you next time.